When oil hits $100 a barrel, it doesn't just affect petrol prices. It raises inflation expectations. It changes rate outlooks. And it forces investors to rethink positioning. But is this a turning point for markets or just volatility?
For a well-diversified portfolio, it doesn't mean a lot, to be honest, which means you've already kind of priced such unforeseeable events into your decision making.
But if oil stays elevated, the transmission mechanism is clear.
And the first thing, when oil price goes up, inflation goes up, which means the funding crunch will be there. When the funding crunch comes through, all the private credit that we've seen in AI investment space, in data centers, will come crashing down, right? And all the big wave of extraordinary valuation gains that we have seen in the tech space will come crashing down. And so inflation is a tax on growth.
The impact of higher oil prices isn't evenly distributed.
Most Asian economies, we are oil importers, we're energy importers. When there is a sudden spike in oil prices, we will be amongst the first to feel the negative impact.
Singapore imports LNG from Qatar. Japan and South Korea are heavily energy dependent. In the short term, that means higher costs and tighter financial conditions. Bangladesh started rationing fuel. Pakistan and the Philippines cut work weeks to 4 days to reduce energy needs. Emerging markets also face a double squeeze. Rising energy costs and a strengthening US dollar both tighten financial conditions.
When the world is at a war, there's only one safe haven, which is dollar, which is US.
For investors worried about prolonged supply shock, tactical hedges are an option, but they must be used carefully.
Our recommended way to do the hedging is the futures-based ETFs. So these are the ETFs that track the daily movements of crude oil prices. So if you are looking to hedge against the worst-case scenario of a prolonged supply shock, I think this is the most precise hedge that is available in the markets right now. Okay? But because it's futures-based, the downside of these ETFs, especially for retail investors, is that these can be very volatile. And I think what the implications for investors who are considering this type of ETFs is, firstly, it should be seen as an insurance, meaning that the position sizing should be very small. It should not be so big that it becomes a directional bet on oil prices.
Other options include oil equity ETFs, though they remain exposed to broader equity risk.
There could be a scenario where oil prices go up, but the share prices of oil and gas companies, they go down, simply because they are equities at the end of the day and they will be subject to stock market risk.
During the crisis, if you make decisions, it's almost always suboptimal. The best decisions about a crisis are always made before the crisis.
For those seeking stability,
in the event of a prolonged conflict, in the event of a prolonged supply shock, what it implies is that inflation is going to go up, central banks will delay their rate hike decisions, and if that scenario materializes, some segments of the bond market will be hit hard, especially the longer duration bonds, which also means that if you want to introduce some defensiveness into your overall portfolio positioning, the areas that you should be looking at in the fixed income space is actually the short duration bonds or even your money market funds. So these are usually the segments that will be less affected by changes in interest rate expectations.
gold can also diversify, but it is not a guaranteed safe haven. But short-term shocks don't automatically erase long-term trends. AI investment continues. Semiconductor demand remains structurally strong. Markets like South Korea, Taiwan, China, and Singapore are tied to these supply chains.
There will be some economic impact through higher oil prices, but for long-term investors who are able to tolerate this short-term volatility, and if they also believe in the long-term growth story of China and the other emerging markets, I think they should still remain invested.
For investors in their 20s, volatility may be an opportunity. Time horizon is their greatest advantage.
If you're young, you should be completely unperturbed by this because you are investing for the long term. And if the market falls now, it's actually better for you as a young person because you get to buy them cheaper.
For young investors who have a long investment horizon, these are usually the investors that are able to tolerate short-term volatility the most.
History supports that. Markets recovered from the oil crises of the 1970s. From the global financial crisis, from COVID-19.
So the one thing that investors should not be doing right now is to panic sell your portfolios. Because firstly, it derails your long-term investment plans. And number two, if you sell your portfolios, you will miss out on any potential rebounds in the market.
Instead of reacting, Wei Ren recommends rebalancing.
Ensure that your portfolios do not drift in such a way that it is no longer aligned with your individual risk profile. Assuming you run a balanced portfolio, 50-50, 50 to equities and 50 to fixed income. And if during this crisis, the equity markets have sold off quite sharply to the extent that your equity allocation falls to maybe about towards 45, I think that is the time when you can consider, bringing back to the 50-50 target that you have set for your own portfolio.
$100 oil shifts the short-term outlook, but long-term returns are built on discipline, diversification, and time, not headlines.
Keep calm, assess, and then carry on.